Perfect. Let's hope that this works from here. We'll find out in a second. But hi guys, Nathan here from All Properties Group. I'm joined today with Amanda Saul from First Street Financials and Bree from my team as well. And before we start, obviously we're going to talk about a lot of things to do with mortgages, to do with the market, everything that we need to do that's going to help us prepare for what's probably coming tomorrow, I'd say. But I'm obviously the lead agent of the team from my team at the moment. I basically just list properties and sell properties, while I've got Bree, the part of my team here as well. What do you do, Bree?
So I'm the buyer manager, so I take care of all the buyer inquiries, all the inspections, that sort of thing.
Yeah, and of course, Amanda, you're from First Street Financials, but who are you and what are you, I guess?
Yeah, absolutely. So firstly, thank you so much for welcoming me along today. So I'm a mortgage broker, and so some people aren't really sure about what mortgage brokers do. Yep. So essentially, I work in the best interests of my client to look at their situation, their scenario, what they want to do, yep. Look at their financials, and then find a lender and a loan product that suits their needs. So yep. I really work for the client. Yep. And the good thing about what we do is that it's free to the client. We get paid by the lender that they choose after settlement. Yep. So we have over 40 lenders in our group, which is lots of choice, which is really good. Yeah,
well, that's what I was about to ask, is why brokers, I guess, is something that people should be talking to rather than going direct to a bank. But I guess when you've got 40 to choose from, it's probably more about just finding the one that suits your client, I guess, better than just going to any bank and hoping for the best.
Yeah, absolutely. And also we help with all of the paperwork. So I do all the application forms, and it takes a lot of the pressure off the client to have to do that. If they went direct to the lender, they would have to fill out the forms and do all that stuff. So
yes, no, perfect. Well, obviously the one thing, the main reason we're doing this video, I guess, is to talk about interest rates and ways for clients and people out there, homeowners, whether they're buying, selling, or they're sticking around, whatever they want to do. While the interest rates we know are going to continue to rise, I think that's been made pretty obvious how to handle that, and I guess where we're going to end up from here. I mean, tomorrow, obviously, the RBA is meeting again, and I reckon there's probably going to be another 50 basis points at a minimum. I don't know whether you agree with that or not, but who knows?
Yeah, I think it's. I think that the RBA are going to put the rates up, and they have said that they're going to look at all of the market conditions each month and make an assessment. Inflation's still high, so it makes sense that will happen. But yeah, who knows how much? So
who knows? Yeah, we'll just watch and wait. Unfortunately,
do you have a guess? I don't have one of these. No, if you get one, can I borrow it at least? Thank you. Yeah.
I mean, look. Obviously, we can look at America as much as we want. In the past, that's been a sort of gauge, and they've gone pretty hard, I guess, in regards to interest rates. There was 75 basis points at the last meeting, and God knows what they're going to do next. We haven't quite gone to that extreme, luckily, but inflation is not doing any better. It seems to be increasing, and obviously the fuel excise comes off soon, so that potentially increase fuel prices again, and there's lots of things happening in the world which is going to be quite interesting. So I think this is perfect timing to talk about getting ready for that. I mean, we all know that those of us on variables are probably going to have increased repayments. If you haven't set up your loan a certain way, there's certain things we can be doing, which I think is going to be really good for yourself. So talking interest rates, and first thing I probably want to talk about is there's obviously different types of interest rates. I mean, we've got whichever way you set up your loan, but I don't even know the lingo. But let's talk about interest rates in general. Like, what are they, and what kind of types should people be looking out for when they're getting a loan?
So maybe we'll start, and rather than jump straight into the actual rates that people will pay for their home loan, how do they get set? So obviously we're talking about the meeting tomorrow with the RBA assessing where the cash rate is. So the cash rate is essentially the cost of money. It's what the banks will pay to get that. And then they're commercial organisations, so they are going to lend that to consumers, and then they'll put their bid on it, and then they make money out of it. So the cash rate will get set tomorrow again for the next month, and they will meet every month. Now, on top of that, then the lenders choose how much they want to put on top.
How much they want to make.
Yeah, exactly. And that's all about risk as well, and lender appetite too. So common rates that we hear in the market are variable and fixed. So the difference between the two sounds pretty obvious. So one moves with the changes in the market, that's the variable rate. And then the fixed rate change as well, and they are more of a prediction of where the market's going to go. So the lenders do a bit of analysis, and they like to also know where they're going to put their money and that they're going to get a return on that for a certain period of time. So if they know that they can lend money to someone and they're going to get that repayment back and that it's stable income, they can forecast better and that kind of thing. So they're going to put a value on what they think that rate's going to be.
Yeah.
And then it's up to us as consumers to choose whether we want to take that on.
Yeah.
So there's no right or wrong. It's all about positives and negatives.
I guess it's dependent on the situation.
Yeah.
I mean, if we look at it now, we look at the past when people were knowing interest rates were dropping, fixing, a lot of people would take a risk and hope they'd fix, but then the interest rates just kept dropping and dropping and dropping,
Yeah.
so it made sense to be variable. And it's funny, as it starts to go up, we're finding a lot of people talking fixed. Everyone's talking about fixing and what they need to be doing.
Yeah.
And it's probably a good time to work out whether that's worth taking the risk or not. I mean, we know CBA is obviously taking a huge jump on their fixed rates, I guess to cover themselves because of how crazy inflation is. They're probably struggling just as much as we are to work out, you know, how far this is going to go, but they're obviously just gone, oh, let's go high. And hopefully that allows any movement. And fingers crossed we don't get to that point, but it's interesting to see. So.
But it's a good point, and they're assessing the risk, and they've got a whole bunch of analysts that are doing that. And then where they're going, oh, what should we do? You know, so it is hard sometimes. A couple of things to keep in mind though are that with fixed rates, if you take on a fixed rate and you either sell your home or refinance your loan during the fixed rate period, you're going to pay what's called a break fee to get out of that. So if people want to take on a fixed rate and they think, oh, I'm going to be here for 5 years, well, you might be, but if things change, you do have to pay that break fee to get out, and that can be thousands of dollars sometimes. So just keep in mind that.
So how's that calculated?
Yeah, it's a percentage of what's left of the loan to pay. Right. So yeah, the bank will, or the lender will assess that at the time when you discharge the loan. Yeah.
Yeah, probably. We go. Sorry about that, guys. My phone just rang in the middle of that and it cut us off. But we're just talking about fixed rates and what happens, I guess, at the end. So fixed rates are only for a certain period. It's pretty rare that they just fix you forever, if at all. But if you were on a 12-month fixed rate now, for example, and obviously the interest rates are rising, what actually happens at the day that fixed rate ends? What does that look
That's
like?
a really good question. And some people don't realise this actually. So there's a thing called a revert rate, which is another type of rate that we can talk about. So revert rate is the rate that the lender will revert to after the fixed rate period. And it's variable. It doesn't roll automatically back onto another fixed rate. You can do it if you want. You have to practically do that. But it's not necessarily the same variable rate as what they're offering the market for new business. So it could be much higher. And in our calculations, we can see what the revert rates are when we are doing the analysis up front. And we can tell you what that will be, but that might change also.
So what you say, so if the variable at the time of applying is 3%, and the fixed was 4.5%, let's say, at the end of that fix, it's not going back to 3%, it's going back to what?
It could be anything.
Could be anything, okay.
So we need to check it.
Well, that's
so
exciting.
I guess don't just take it for granted that it is going to be that. The rate that we're talking about today when we're applying for your loan, it may not be that.
So at the end of the fix, if you're coming towards the end of the fix, what should people be doing?
If they're working with a broker like me, we will proactively contact them and say, hey, this is finishing soon. Have you enjoyed what rate you've been on? The fixed rate, do you want to look at fixing again? Has it worked for you? Has it not? And do what we call a health check on the home loan. So we'll proactively do that, and it's another advantage of working with a broker. The lender may not, and usually doesn't. They'll let you know it's finishing, but then it's up to you what you do.
So you could refinance, I guess, and go back to variable, or you could just refix, like you said before, whatever the rates are.
You just need to relook at it and re-strategize at that point. But it's important not to just let it happen and then not look at it, because you may be in not a great situation at that point. Or compared to what's on offer in the market.
One other rate, I just thought of this on the top of my head, because when I got my first ever loan, I heard this comparison rate. It took me years to work out, this is when I was much younger, it took me years to work out what that actually meant. I think any first home buyers that are watching this or going to watch this might have that same thing. What is comparison rate? So we see it a lot in the media. So a comparison rate was brought in so that consumers could compare apples with apples. So it forced lenders to actually do an assessment of the rate based on a standard loan amount and loan term, which is a $150,000 loan term, a loan amount for a 25-year term. Now that's quite low, but it does include fees and charges outside of the interest rate.
and it also includes the interest rate for the life of the loan. So sometimes there is what's called an introductory rate, which is another type of rate.
Yeah.
They're not as common these days, but they have been in the past, where you might get an intro rate of a certain reduced rate for 2 years, for example, and then it will go higher after.
Yeah.
But you're going, oh, that's a great rate, but that's actually only 2 years of a 30-year term. And so the comparison rate takes all that into account and gives people a better idea of the actual rate that they're paying when you take into account other fees and charges.
Yeah.
It's important that it doesn't include all fees and charges, so there's only certain ones, but it does help.
Yeah, it makes a big difference. I mean, once I worked out what that meant, it was funny when you looked at the comparison rates of certain banks at the time in comparison to some of the smaller ones. And this bank looked really good before you looked at the comparison. Then you just go, these fees are massive.
And people being caught out.
I was caught out for my first ever car loan. Didn't look. I sold it very quickly once I figured it out, because it was crazy the difference in the fees that I was paying. And I guess most people wouldn't have realised that.
No.
I didn't even look at it like in the beginning. It's still even something I even thought of. So.
And it's people that are not experienced in looking at this stuff every day.
Yeah.
You know, it is a trap that could potentially happen. So that standardising is really helpful.
Yeah. So let's say at the moment, right, where we've got me, let's say, and I'm selling my home in order to purchase a new one, right? My home currently is completely variable, but I'm looking to upgrade, right? If I'm looking to sell to buy, at what stage, like to work all this out, at what stage should we be talking to you?
Even before,
Okay.
now, anytime. I work with a lot of clients in the lead up, a lot of first home buyers who are quite young and really just starting out, thinking about what do I even need to know. Decisions and choices that you make now can really impact even in 5 years, like with the credit report and things like that. So getting a strategy around how much deposit or funds to complete do we need. So when you're actually looking at buying a property, it's not just your deposit that you need to think about, it's how much extra money do I need to buy the house. So there's things like conveyances, there's or lots of other costs. And we can do what's called a funding position that I often do hypothetically for people, where it's like, okay, well, we're thinking of buying in this suburb at that price. We have this at the moment, but if we're saving this much, we'll probably have this by that time. Well, we put all of that into a funding position and go, okay, well, we're short, or we've got plenty, or, you know, and it also gives us the loan amount. And then we look at a borrowing capacity on their current income to look at, well, can we get that loan? So there's two parts to it. And then if they're on track, fantastic. If they're not, they can make adjustments leading up so that they will be in that position when they get there. So it doesn't mean you have to come to me that early, but it's helpful.
Yeah, 100%. I mean, it's always good to know exactly what you need to be doing. If you've got a credit card, knowing that that's probably not going to help you, and you can get rid of that and all those sort of things. I know that obviously from a buyer's perspective at the moment, Bree's dealing with a lot of buyers that are selling in order to upgrade and have never spoken to a broker, or we had one recently, not understanding what most terms
Yes, this is what I was about to say, on the weekend. So he was looking at placing an offer of a certain amount, but then realised that he had to pay stamp duty. So he realised that he couldn't actually place the offer at that, so he's reduced the offer, realising that, that's where he was sort of maxed out. So he just didn't understand because he hadn't been through that before. So,
and some people think you can put stamp duty and fees on top of the loan. And they need to be paid at settlement. They're a tax that goes to the government at settlement. You need that. And that's where the difference, when we're talking about deposit, that's the bit that you give the lender towards your purchase. But funds to complete includes the deposit and all those other things. So part of what I do is around the education that comes with that.
I think that's probably a big thing, especially not just first home buyers, but first time sellers. I think we're going to be coming into a market now where first home buyers in the last 3 years have made more money than they could ever dream of. Because no one predicted the market to do what it's done.
Absolutely.
And they're going to be looking to upgrade because, of course, the changeover price now in the real estate world, right, if we take a step back from mortgage broking right now, the changeover price, the first home buyers have made $300,000, $400,000 in their home, and they were thinking, I'm going to have to spend, an extra $1 million to now buy. But if the market changes by 20 to 30%, the changeover comes down in that exact amount as well, and the lower priced homes aren't going to have the same effect. So the first time sellers are going to be a huge shift, I think, in the next 12 months. And you'll probably see it before we even see it. But I think that's right. It's a really good thing to talk about how that even works. And, we're already experiencing, people aren't talking to brokers. They don't know what unconditional means. They don't know how long they need for finance. All these things come into play. But we'll jump back into what we were trying to talk about. We sort of got off track for a minute there, which is my bad. But variable and fixed, right? We sort of spoke about this before. Obviously, when you're going fixed, you're almost taking a gamble as to if you're going to lock in, you think variable is going to go above that, right? Would fixing a percentage instead of the whole amount of the loan be of benefit to some buyers?
Yeah, absolutely. So it comes back to the strategy and what's important to the person. So if they're really worried about interest rates and they want to just make sure that they can make the repayments, and they don't mind if it's slightly higher, they know what their repayments are going to be every month, and that relieves their stress, and that's what they want, absolutely, that's fine. So if that's not the case, you know, people just want to write it out and just see what happens, you know, that's okay too. So, so if people are not sure and they're kind of in the middle, to your point, you can do both. So we can do loan splits. So when we're applying for the loan, we can actually split the loan into two separate parts and apply a fixed rate to a part of it and a variable rate to part of it, and you're kind of hedging your bets a little bit. And you mentioned earlier that you've had some experience with that as well. Yeah,
well, I refinanced pretty much as soon as I heard the interest rates were going to start going up. I quickly jumped on it, refinanced and drew out the equity that I wanted, but I made the decision to only fix half, which in the beginning I was going to fix the entire amount, right? But that's why I've gone, because I didn't want to hedge my bets completely, right? I'm not a gambler, so hedging completely wasn't in my best interest, which worked out well. Unfortunately, we're already probably to the point where I should have been in the end, which is why I'm talking about this.
But hindsight's a wonderful thing, right? How do we know? Like right now, to make that decision again, you know, it's so hard to know what the best financial decision is, because we have no idea what the rates are going to be. So it really comes back to your level of acceptable risk.
Yeah, exactly right. But talk about, like, let's go homeowners now, right? I've fixed half of my loan. So the variable rate's going up substantially isn't going to affect that small portion as much as those that have a $600,000 loan completely variable in this marketplace.
Absolutely.
What should people be doing, I guess, not only just to prepare, but to try and take the pressure off that extra financial stress that's going to come from this? What should people be doing?
Yeah, it's a really good question, and I pretty much get asked this every client that I work with. You know, interest rates are going to be what they'll be. We can't change what the Reserve Bank's going to do tomorrow. And it's outside of what I call the circle of influence. So the things that we can influence and control inside our circle are the things we really should be focusing on, because worrying about what interest rates are going to do, listening to the hype and, you know, the media and everything like that, it can be unsettling, and it's actually not really helpful. So let's go back to what can we control. And so there's things that we can do to try and minimise the impact that it's going to have. So the first thing I would recommend is have a look at what you're actually spending and seeing if you can try and cut back in any ways. Now, things that we have to spend money on, like fuel, food, you know, things like that, but non-discretionary spending that may not be necessary over time may need to be cut back to be able to make those extra repayments, or the repayments will go up because of the interest. So start doing that now. See how that feels. You know, get used to it, and that way you're not doing it because you have to. You're actually choosing to, and there's less pressure around it as well. The second thing would be to consolidate some debt if you can. So if you've got, say, credit cards or any kind of other non-helpful small debt that are on high rates, you can often consolidate that, and often into your home loan as well, if you've got equity available, which is a much lower rate generally than what a credit card or a personal loan is.
What about using those like Afterpay and those type of facilities out there, and those little short-term loans? Like, do they affect? They
do definitely affect. They do, and they also affect borrowing capacity if you're going for a loan, because you've got this committed short-term spend, but it's committed. But that is definitely one thing that I talk to people about when they're applying for a loan. But even just in affordability, while you've got the loan, losing that buffer when your car breaks down and you need to fix it, you get a flat tire, whatever happens. If you have committed to your Afterpay next month because you didn't pay for things this month, or go without it because you couldn't afford it, then that money is now committed and you don't have the money for the tire. So it's just about, we call it the financial buffer that you've got in your household and in your situation. If you're pushing yourself to the limit every week or every month, if something goes wrong, you really don't have any kind of backup. And interest rates are going to force us to pay more for our home loan repayments if you're on variable. And we can't do anything about that. But we can limit what we're spending so that we've got a bit of buffer. We can get ahead on our repayments so that we've got that there in case we need it. Often you can redraw that. And consolidating unhelpful debt or high cost debt, like interest rates that are much higher on credit cards and things like that, will really help. You can also do things like talk to a broker about restructuring or refinancing the loan that you have at the moment. If you've experienced what we call rate creep over the last few months, where the last 3 months the interest rates have gone up or the cash rate's gone up 0.25, then 0.5, then 0.5, and then maybe tomorrow again, your variable rate will often go up the same way. So the interest rate you're paying will do the same thing. But there are still rates available for new lending that are competitive. So it might be worth looking at that. Some lenders are doing cashbacks, so they're rewarding new customers. So they say, come work with us and we'll give you that cashback. It often helps pay for any fees that are associated with leaving the lender you're with, and is a little incentive and helpful. But you don't even have to do that. You can stay with the lender that you're with and just look at the way you manage your money better. You can look at restructuring your loan, using your redraw or your offset better. If you've got some extra funds and they're not sitting in an offset account and you're paying for a package, you're not using that in the most effective way. So, I'm happy to talk to clients about existing facilities and say, well, how are you using this? Is this the best way you can do it? If it's a good rate and they're otherwise happy, well, I'm not going to refinance them. Let's just do this better.
No, 100%. And look, for me, I mean, interest rates are just the start of everything. At the end of the day, interest rates have been used for property. People are borrowing money to buy property and taking things back into the property market right now. And I keep saying this to sellers and to buyers. To be completely fair, I think right now, while the interest rates are in the creeping period, it's probably the best time to either buy or sell and make a move, because we know that they're going to continue to go up. Now there's the time to probably hedge your bets, buy a property, whether you decide to lock it in completely, lock in a percentage, whatever you're doing, get yourself completely restructured so that when you get your new loan, your new home, whatever it is, your repayments are set up. You know what you need to do. You've hopefully got a budget, which we'll talk about in a second. Everything's then set up, ready to go. Whereas I think that the longer people wait, the current buyers or current homeowners that have been wanting to sell to upgrade for so long, they've made great equity, but their interest rates have been creeping, and they're going to continue to do so, which obviously, as I'm sure you can confirm it, the higher interest rates go, usually the borrowing capacity will change. Right? As repayments get higher, it's going to affect your borrowing capacity, unless you're a squillionaire, right? Because it doesn't affect you, right? That's just the way it is.
But it's even for them as well. Like, it's more expensive. The home loan repayments are bigger, which then, you've got to take that into account, so you'll get more changes.
So I think that's probably a good time to be doing things now, in my personal opinion. But let's talk budgeting. So I just mentioned it for a second there, and we sort of spoke about it briefly. I'm a budget Nazi. I love budgets. I actually learned from back when I was selling cars. One of the trainers was like, "Where's your budget?" I said, "I don't have a budget. I just pay the bills if they come and hope for the best." And he's like, "Just break down every single bill that you get annually. Break it down to a weekly amount. Allow for tires. Allow for things that go wrong, and when these bills come up, you'll never feel stressed, and then you can allow and adjust as interest rates go up." So I'm on mine. I've got a spreadsheet. I run it every single day. Do you have any advice for people that need to start doing that aren't for budgeting? What should they be looking at? Is there help?
Definitely. So I would definitely look online for a budgeting tool. The government has one on moneysmart.gov, I think it is. But just Google that. And it's a great place to start. Just knowing what you're spending, I think, is really important. Part of the loan application process for me is actually talking to people about what they spend and their living expenses, and we have to take that into account when we're applying for the home loan. And it's really hard to know, like in your mind, how do you add up all the things you pay for in a month? And then, when you need to put it on a piece of paper, that's impossible. So keeping track of what you spend, maybe not everyone would do it as well as you. I'd make my job easier if people did. But there are definitely some ways around that. And I can help people with that when we need it for the actual application. But even if you're just looking at budgeting in your household, it's so important. And you should look at getting some kind of a spreadsheet or, budgeting tool. There's apps as well that you can use to keep track of things. Because then it's also an eye-opener. It's like, well, how much do we actually spend on takeout, and how much?
And there's little things that you don't like, like Netflix or there's subscriptions and stuff that seem like, oh, it's only $12 a month, but then you've got 2 or 3. But, you actually realise. How's
your gym membership, by the way? Is it still going?
Not talking about gym membership, thank you.
I know people that have 3 or 4 gym memberships but don't go to the gym, right? And all these repayments start adding up. I was one of them for so long. I was paying for gym and never going. And it wasn't until I started looking at getting a home and I was like, I should probably cut that back for a bit.
And also, it's a waste of money. Like, it just doesn't make sense. Not just because you want to get a home loan, just because you're literally throwing it away. So,
100%.
I think it's important to have a good budget. How tight you want that to be is up to you, but we definitely need to assess that as well.
Yeah, I think you've got to allow for some fun stuff in your budget too. But before, because I think my laptop's about to die, we've been on here for a little while, let's wrap this up with the real estate side of things, right? Obviously, I know what people should be doing when they're looking to sell, and we can talk about that, and we can talk about what they should be doing when they're buying. But what's your tips, right? If someone were to come to you tomorrow and say, I want to buy a home, I think I'm ready to go, in regards to the areas that they're looking at, what they should know about the properties, anything that's going to help, I guess, the process from actually getting an approval point, what should they be talking to you about? What should they be looking for? Yeah.
So the first thing I always say to anyone who I'm talking to about a home loan is why.
Okay.
Just why. Why? I want to buy a house. Great. Why?
Yeah.
I want to buy somewhere to live because I'm sick of renting. Fantastic. What will that mean to you? Well, you know, buying your own home could be, I don't want to pay rent anymore. It could just be, I want to be able to not have someone come through my house, and I want to be able to put pictures up, you know. Is this an emotional drive or is this a financial drive, you know? And this will help me understand them, because I legally and morally have to act in their best interest. So if I don't know what's important to them, I can't tell them that what we're doing is the right thing. So that's the first thing. I'm not going to tell people they should or shouldn't buy a particular property or in a particular area. I don't think that's my place, but I will absolutely ask them to justify their choices to themselves and to me, so we know we're not just throwing things up in the air. It might be around a particular school that they want their kids to go to. Fantastic. That's a great driver. It might be the space of the land that they're looking for. So I don't think it matters what it is, but they need to have a reason.
And Bree, to end this off, from a buyer's manager's perspective, your job is to build relationships with buyers and help them from the moment they inquire to when they're moving to their new home. What makes it easier for you, I guess, or what makes it easier from a buyer's perspective when placing an offer with us?
Yeah, well, definitely being prepared and being ready to go, because it can be the difference between, you know, securing your dream home or missing out, because you might have that other person there that's already been and seen the broker or the bank and they've got their finances in order. So it's definitely, I think it's an absolute must that, you know, if you are serious and ready, you know, wanting to go and find that home, that you are completely prepared and in a position where you can just jump on it straight away and go, put the offer in.
100%. I mean, obviously the market's changed. So those buyers that are watching this that have been waiting for the best point to buy, now is the time. There's a lot less buyer competition out there. But if you come to a property less than $1 million where we're still getting a good amount of buyer interest, and you place an offer at $850 and the next person's placed an offer at $850, the other one's pre-approved and you're not, no matter what, the one that's pre-approved is going to get looked at first. So definitely start talking to someone like Amanda and work out exactly what you can do. Get that pre-approval letter, so when you walk into an open home and go, this is our dream home, you can talk to an agent and honestly tell them, we're in a position to buy it. We've got a deposit, we're pre-approved, here's the letter, and the agent is going to be able to help and advocate for you to get you the deal over someone else that might be $5,000 difference, right? But they've got no pre-approval whatsoever, and it's a more risky deal from a seller's perspective, which is where I come on board. But I think that's probably going to wrap us up. So we'll definitely keep an eye out. We're going to be doing another one. Hopefully we can organise this monthly and continue going. Amanda's going to be giving some advice for my emails. If you're not on my e-newsletter, please get in touch and jump on that as well. A lot of things are going to come from this. And if you have questions, put it in the comments below. Get in touch. I'll comment below on all these with Amanda's details and all of our details as well, whether you're selling, whether you're buying, whether you refinance, whatever it is. Any one of us, Nathan, Bree, Amanda, we're always happy to help. It's weird saying my own name. But hope you all have a great day. Thanks so much for everyone for jumping on. It's a shame about the weather, but fingers crossed some sunny weather pretty soon. All right, talk soon, guys. See ya. I think the laptop's literally going to turn off as soon as I press this button. So let me press the button.